Okay, hello, folks. Welcome to Geez, I was caught off guard here. Welcome to Pro Trader Strategies. My name's Eric Wilkinson, and this is Spotting the Trade. I'm going to get you folks what you need to know before you roll, and that's going to be discerning the economic data, see how that impacts the overall markets with some market analysis, maybe sprinkle in a little geopolitical fodder, and then we'll talk about some option strategies we could use to implement into our portfolio at any given time. So without further ado, I popped in here a little bit early. Why? Because we just had breaking economic data that I wanted to talk about here. It is going to be market moving. Why? Because I think it's going to stir up the pot here a little bit heading into the FOMC today. So what do we have going on? We've been talking about inflationary data. We've been talking about the energy complex when we're talking about crude oil and things of that nature. Well, these data points are huge, to be quite honest. Well, here in the United States, we saw core retail sales. Remember, that's going to strip out some of the more volatile aspects of that data point, like automobiles, retail, things like that, where we see fluctuations in that buying patterns there. That number did come in lower than expected. That's good to hear. 0.5 expected to be 0.7. They also revised last month's number down, albeit 0.2%. So that's starting to make, at first blush, these inflationary pressures a little bit better, because we're still seeing folks go out there and buy, despite the fact that we're seeing some of these higher interest rate, or higher commodity prices and things of that nature, higher inflation. Retail sales coming in at negative 0.3, not what we wanted to see there. We've been seeing these manufacturers build inventories coming into the summer, and I've talked about this. Summer is usually a lull in buying patterns for the retail sector. Why are these manufacturing sectors really cranking up, or at least keeping these elevated levels? Starting to show up here in the retail sales numbers that folks are pulling back on that buying patterns. All right, we've been talking about this. When we see crude oil making moves like we're seeing right now, those crude oil prices are going to crimp buying patterns, right? Well, I've talked about this several times. When you are out there and you are looking to buy certain products, right, you are going to be less likely to jump out there, buy new things when you are seeing the economy do what it's doing. And that being that we're seeing these inflationary pressures. You and I still have to go to work. We cannot avoid that process. So if we have to go to work, well, we're going to have to spend money on gas. That's the energy aspect that this administration is really giving some pushback on. And with crude oil at these levels, everybody paying $5 on a national average, where it used to be somewhere around $2, maybe $2.50, let's call it, it's doubled. So that other half, when you were spending, say, $30, $40 to fill up your tank, now you're spending basically $80 to $100 to fill up that tank. That extra money, that's what I've been talking about. Where is that money going to be pulled back from? Whether it's going to the Starbucks or Dutch Bros or the restaurant where you're not getting a dessert, or maybe not getting a second drink at dinner. You're not going to go get your car washed. Those are places where we are going to see pullbacks in spending, and retail sales is another thing. If I've got to spend a bunch of money on the gas, well, retail sales is probably something that's going to wane a little bit. We did see manufacturing start to pull back here in the Empire manufacturing number. That came in at negative 1.2%. One of the first times we've seen that these manufacturing indexes come in below, which is real pullback here. We're expecting a 2.4% there. Actually, Empire manufacturing last month was pretty bad. So better than that. It was more negative. What was importer prices? So importer prices did come off a little bit, 0.6%, expected to be 1.1%. One of the things that we've been talking about is sometimes folks say, hey, when you have inflation, you try to just export it. It's so easy. Well, guess what? We're seeing the highest inflation we've seen since the 80s here in the United States on our export prices, and it's up almost 18%. So exporting our inflation is not going to work when we're seeing import prices come in lower than expected and our export prices are going through the roof. Nobody wants to buy those higher prices. So we're going to have a tough row to hoe going forward. So all of these inflationary data are not looking too good. What does that mean for us? Well, we've been talking about the Fed, right? Today is the FOMC meeting. It's a 2-day meeting. They get something that is called the blue book. Remember, we get the beige book. It's kind of one of those numbers most people don't really look at, but in a time like this, you need to look at the beige book, folks, because the blue book is what the FOMC gets, and it's just a revision a couple of weeks later. So you and I have already seen all this economic data that they've seen. We've had this on the back of our minds, so we can really keep an eye on it and say, hey, we really haven't changed a whole lot in the last 2 weeks since the beige book. They're getting the blue book, so that data is just about the same. What does that mean now? Again, expected to be a 50 basis point raise today. I think that we might even get a 75, especially after seeing this data here today with the inflation. Even when we strip out the more volatile aspects of these inflationary numbers, food and energy, we're seeing the core really start to rise. Now, when the core rises, that's not transitory, folks. So how do we avoid all of this? What I think the administration needs to do is do a 180 pivot, because literally everything is being driven right now by the crude oil markets here. And we can see crude oil has come off of that testing, that 125 that I talked about yesterday. That was a key level. We broke down below the 120 area and settled in outside of that 120 handle. All right, that is huge. It's a psychological level that I was hoping we could avoid. Now we're starting to peel back. Hopefully we can see this roll over. One of the best ways to see all of this stuff just poof and magically, almost magically disappear, will absolutely change the direction of this economy, is for this administration to come out and say, we are going to start opening up oil fields. We're going to release these permits that these folks were asking for and clamoring for. We even have refineries that are offline. I actually know of one in Fort Wayne, Indiana. It's Gladio Oil. They have an oil refinery right there. And what do? They're a trading operation, folks. Basically, EPA and everything else, they can't really operate it like they used to. So they've shut down those operations. They're using that to store like canola oil or something like that in these great big huge tankers. Now, it's a long story. No, they did not just go in there and put that oil in there afterwards, the canola oil that we're all eating in after the gas was in there. No, that's not really how this worked. They did a complete retool and die of that structure there. Couldn't get it back up and running because of different laws and everything else that had happened during their rehab, if you will, or they had an explosion, and it made it very difficult for them to start back up again, despite the fact that they retool and died the whole thing. So yeah, there's a lot of ancillary aspects to why these guys aren't able to produce oil right now. But the fact of the matter is there's a refinery sitting there idle. Okay, enough said. Capacity utilization is offline a little bit there. So with all of that said, this oil is what's driving everything, folks. It's from food. When you're trying to transport food, it's from getting metals out of the ground. Those big, massive dump trucks, those things gobble up diesel. That is petroleum based. We're using petroleum to get this out. So all of those prices have incrementally moved higher. We're seeing shipping costs here in Arizona really ratchet up, making it very difficult for a lot of businesses to continue operations. If you think about it, a lot of businesses set up their contracts years in advance. And when they have those years in advance contracts, well, guess what happens? That is budgeted based on current pricing. And when we've seen pricing double, there's no way that those guys can make up for it. So we're obviously going to see that try to pass on to the next level, whether it goes from wholesale to the retail level, to the consumer level there. So crude oil really is driving this entire market, as we all know in the back of our minds. This is the key thing that we need to get moving south. And the only way to do that is to pivot quickly and say, hey, we're going to start opening up these oil. We're going to kind of release this, ebb this inflation. There's nothing else that's going to do it, folks. It's going to continue to ratchet up higher the more and more this administration holds off on pivoting a little bit here, I'm sorry to say. So like to see that. I think that actually there's going to be so much pressure coming from his party that he is going to actually have to make a decision and pivot to allow some of this to happen, because otherwise I think the next election folks are going to turn and vote the other way to try and get this to happen. Because listen, we aren't all stupid. We know what is driving this, and it is crude oil. This is what is crimping our advancement here. Now, bonds trying to make a little bit of move higher here today. I think that's a bad mistake. I talked about this. Anytime we get a move higher in bonds, at least for the next 6 to 8 months, I think that we need to stay away from that or sell some covered calls. That would be to lower the overall cost basis in our portfolio. So please keep your eyes out for that. 75 basis point today could send bonds tumbling there. Another view I've had and kind of bounced back and forth in my own head here is if they do 75, do the bonds actually get a bit of a bounce here, because that would signal that they're going to raise rates at maybe the next meeting. Put a 75 out there, kind of slap the markets. Hey, here we go. We're really coming after inflation, and then maybe take a little bit of a pause to see where the market shakes us out there. So I think that the Fed, it's a better than 50-50 chance, I think, right now that the Fed could go 75 basis points today with the way the inflation's happening. It's not going to do a whole lot, folks. It's just not. That extra 25 basis points just going to be more of a shot across the bow to the markets that, hey, we're getting aggressive here. Gold futures, when we talked about this, there's got to be some type of move to cash right now. Folks aren't really reinvesting this money where they're raising cash, but we've seen this where inflation is rampant right now. And the last thing you want to do is have idle money sitting there because it's losing to inflation. Remember, we just talked about a 10%. That means if you hold on to that dollar for a year, it's only worth 90 cents. Okay. So folks look to the markets to try and get involved. And gold futures is usually the one that is the first line of defense for parking cash. And we're not seeing that as of recently, just not seeing the influx drive this market higher. I was expecting us to stay above the previous all-time high of 1923. We sold back. We're literally $100 lower than that, back to the point of control, where the most time and volume has been spent for the last year. We could probably even draw it back even further, and it's not going to change too much. So let's just go back from a week. So you can see that point of control for the last 3 years is still right there, maybe slightly lower, but at the end of the day, value for the last 3 years is right in and around where we're currently trading. Does that make sense to you? We've seen inflation in the last 3 years really ratchet up. So that would expect us to see a paradigm higher here in gold that we're just not seeing folks put money into. Now, Bitcoin looked like it was finding a bottom yesterday. I just don't see this market as finding a bottom before we really test this 18,300. We haven't gotten there yet. 20,000, first psychological level most folks are going to be holding on to. The real line in the sand, though, is that 18,300 that we're going to be looking for the market to test. And if it breaks that, folks, it could be off to the races to the downside, as people will turn their hands around and start raising cash that way as well. Then we get on to the VIX. VIX is staying elevated. That's because I think that today we're going to get a little bit of a bounce here, but we could see a panic happen if that 75 basis point move starts being pushed. All right. So I think that more and more this day drags on, the folks that are trading are going to start thinking 75. Now, if we only get a 50 basis point move today, we could actually see a bit of a relief rally as the traders are thinking that inflation isn't as much of a concern to the FOMC. Well, I think that inflation, they thought it was transitory, folks. And when we strip out the volatile aspects, those transitory aspects of the inflationary numbers, well, we're seeing those still stay elevated. So I don't think that the only way, folks, to get rid of this non-transitory inflation is to get rid of higher oil prices, because that is the catalyst that's driving prices higher. everywhere because we are transporting using that fuel for the most part. Everything is looking like they're trying to find a bottom. Well, I shouldn't say everything. The NASDAQ was the one that really made it look like we were trying to find a bottom there. Right there, came down and tested the 11,250, if you will, and bounced away from that. Looks like it's getting confirmed today. So when we have these indecision dojis down at the bottom of moves, that's usually a good sign that you can put your toes in to test the waters. That's not going to be me today. Why? Because the other markets just are not showing that. This is a bit of an indecision candle where you have the wick as long as it is on the top as it is on the bottom and a base there. I would say that those indecision days are usually a continuation pattern. So I would stay away from jumping on board any type of even confirmation here. It's just been too bearish to really get this snap back higher. I think that we might try to move up into, let's say, 31,500 area. That could be where we relief rally to. So look for those at levels. That's where I'd be looking to start to sell some covered calls in there that I've been talking about. Same goes for here in the E-mini S&Ps. You can see we got the gap down and a continuation. Yesterday's candle may make some folks believe that we're going to get a little bit of a relief here. I believe we might. It's only going to be a relief rally. We might come up high enough to cover this gap before we start resuming. So we've been getting a lot of these dead cat bounces, and very similar to this one here, where we make that big drop, a bit of indecision, relief rally, kind of half back, if you will, and then another slam down. So we've got a massive slam down, could get this relief rally, maybe half back. I'm thinking it's just going to cover the gap before we start resuming that downside. E-mini S&Ps overnight pretty flat, even with the economic data that we've been getting here. ECB had an emergency meeting. I didn't really get all of the gist of what was going on there. They did not move rates, but it was with regards to the inflation and everything else that we're seeing here and the economy slowing. Over there, we've been seeing the kinks in the armor a little bit earlier than here in the United States, but I'm telling you folks, is these higher gas prices drag on, it is really going to seriously impact our markets going forward and our economy. We need to spend up the spending right now to keep up with some of this hiring we've been seeing. We've been seeing a lot of hiring. It's been so difficult to hire that these higher prices could get folks to not even worry about hiring anymore. So we're going to have to see how that goes forward. Today, though, I would say that 50 basis point rise is 100% going to happen. That is going to happen. The fly in the ointment, or I guess the wild card, for lack of a better phrase, is going to be whether that extra 25, making it a 75, happens today. And I'm leaning towards that 75 happening. I would say it's probably, I'm giving it about a 60% probability. I wanted to say 80. That was the first number that came off my head, but I think that seems a little bit high. So somewhere, let's call it 70% probability of happening. Okay, call it in between. So keep your eyes out for that 70 basis point increase. I think we could see the market just kind of consolidate here, try and figure out what the heck the Fed governors are thinking, whether they're going to slow down on the rate hikes, take a breather here, or continue at this torrid pace of raising interest rates. Guys, if they get to 4% in the Fed funds rate, that basically takes us back to the 90s. I'll have to go back and find some trading cards, because I do have some trading cards from the 90s when we were trading at 94.50. All right, which means that's basically looking at a 5.5% overnight interest rate. Keep in mind we were future, so that was forward looking. But yes, I was writing down 94.50, which is a 5.5% interest rate. I'll try and find some of those cards for you guys just to share, show and tell. All right, one of these videos. Other than that, though, good luck trading today. And if you can't take that, take it easy.